Quantitative methods of credit control. The students will be able to understand the quantitative methods of credit control taken by central bank. To control the money supply in the economy, the central bank keeps a close watch on credit creation by the commercial banks. Central bank adopts quantitative and qualitative methods to control credit creation by commercial banks. Let us first study the quantitative methods of credit control. The various quantitative methods to control the availability of credit are bank rate, cash reserve ratio, statutory liquidity ratio, open market operations. Bank rate. It refers to the interest rate charged by the central bank from the commercial banks on loans and advances to control the money supply. When the bank rate increases, the borrowings become expensive for the commercial banks, which encourage them to increase the interest rate at which they provide loans to the general public. Increase in the interest rate makes borrowings expensive for the public, which leads to a decrease in the flow of money or credit. And vice versa when the bank rate falls. Cash reserve ratio. It refers to the ratio of the total bank deposits to be kept with the central bank by the commercial banks. Increase in the cash reserve ratio will force commercial banks to keep more cash as reserves. When the cash reserves increase, it discourages the banks to lend more money in the economy, thus leading to less flow of money or credit creation capacity. And vice versa when the cash reserve ratio falls. Statutory liquidity ratio. It refers to the minimum proportion of the total deposits to be held by the commercial banks in liquid form. Increase in the statutory liquidity ratio will force commercial banks to keep more cash as reserves. When the cash reserve increases, it discourages the bank to lend more money in the economy, thus leading to less flow of money or credit creation capacity. And vice versa when central bank reduces statutory liquidity ratio or SLR. Open market operations. It refers to buying and selling of government securities and bonds in the open market by the central bank. Sale of securities by the central bank to the commercial banks leads to the flow of money from the commercial banks to the central bank. This restricts the lending capacity of the commercial bank, thereby reducing the credit creation capacity. And vice versa when central bank buys government securities through open market operations.